name is Simone Krummacher and I'm a senior lecturer in insurance at Cass Business School. Today we welcome Robert Frank, Global Head Insurance and Risk Mitigation at Gerald Group. Looking back, have your reasons why you engage with risk mitigating instruments and insurance, have these reasons changed maybe during your time in the last 10 years?
Actually, that's a very good point because they have changed dramatically. When I came into the company about 19 years ago, the banks were still very much involved in taking on risks for themselves. They were earning the spreads, the margins, the fees for taking on such risks, and would typically look to Gerald for maybe 10% or 20% of the total exposure. So for us, insurance was more of an ad hoc, occasional purchase because the banks were in the markets buying the insurance, using it themselves. With the crisis, 2006, 2007, everything turned upside down. The banks were really under such stress that they were not in a position in most cases to take on these political exposures or these international commercial exposures. So in order for us to continue our merchanting business, we had to step up our utilization of the market. So when we first started off doing one deal every 3 or 4 months, during the crisis and then post-crisis, we found that the deal flow was increasing dramatically, exponentially, because the bankers were just not in a position to do it. We couldn't stop our business model, so we became more involved in insurance, working with a number of brokers here in London in order to ensure that we could continue our merchant financing business. So the demands on us grew as a consequence of the crisis, which obviously reoriented everybody's business model following the end of the crisis.
And do you think at the moment the markets are back to where they were before the crisis, or are there any kind of really fundamental changes?
Well, post-crisis, unfortunately, I don't think the banks are back to the way they were, and I don't really see that changing for the foreseeable future. Maybe it's even getting harder for the banks because of capital adequacy requirements and Basel III and IV, et cetera. So I think it's still going to be a merchant's game, a merchant's program. We have committed a substantial amount of resources to generating insurance support. We are working with underwriters throughout Lloyd's. There's about 50, 60, 70 markets at Lloyd's that specifically focus on political risk and trade credit insurance. And we invest a lot of time and energy in getting to know the insurers, developing good personal relationships with them, because fortunately it still is a relationship-driven business. We have brokers who work with us as well that help facilitate, but we've had to take our future into our own hands and ensure that the insurance markets react favorably to us because the headwinds are becoming stronger. And as a postscript to your question, in the last 2 years, and I suspect going forward, the situation at Lloyd's is going to become even more challenging because of factors external to what we as a merchant are doing, but because of underwriters being under pressure because of natural catastrophe losses, other claims that have happened around the world over the last few years, and their business models are no longer supporting a lot of this type of capacity. So we have to redouble our efforts to make sure that we can get access to the insurance capacity that we need in order to help maintain the financing support of our banks for our trade transactions.
You're actually already taking my next question forward. I wanted to ask you about the underwriting cycles and the Lloyd's and London market. As you said, we see obviously some tightening in the markets and the capacities at the moment. Do you expect this trend to go ahead within the next year or 2 years? Because some say the market might bounce back, but we might see a kind of harder market phase now.
Yeah, I do have a view on that. And unfortunately, the view is that I think the situation will continue to get worse before it gets better. Last year, I think was the first time we really saw it starting to come home. We're right after the new year in Jan. One of our long-standing underwriters, who had actually been in a number of our policies, found that they were no longer going to be able to underwrite. Their unit was getting out of the business, and unfortunately the way the individual underwriters found out about that they were no longer having jobs was reading about their jobs in the loss of their jobs in the newspaper, congratulating them on years of service. That was the beginning of shoes starting to drop. So subsequently throughout the balance of the year, there were quite a few more underwriters that, when I say underwriters, not just the individuals, I mean the underwriter markets, that were no longer writing, that were withdrawing from the market. It's an alarming trend. I suspect that come Jan 1, 2019, there'll be a lot more of this because it's building up to a head of steam that is, again, not favorable to capacity and pricing and so on. Notwithstanding, I think this just further justifies the time and effort and money that Gerald Group has put in on insurance relationships and insurance utilization, because we have redoubled our efforts to ensure that our contacts and our connections and the market reception of Gerald and its business does not get adversely impacted by this tightening, which I think I know is affecting other people, but we have to just make sure that we do an even better job than we've done before to ensure that the market is receptive to us, notwithstanding a trend which is not your friend.
If you could change one thing in the insurance products you're currently using, so if you would have a wish, what would this be?
In crisis, there's always opportunity. This is what a trading company does. It thinks counterintuitively. So if the product that I have available from the insurance markets has inefficiencies or weaknesses, I can do one of two things. I can fold up my tent and go home, which I told you we're not going to do. Or we can look at how the insurance markets are evolving, because while markets are getting out, as everything else, an opportunity, a crisis creates an opportunity. Some of the individuals that were working for a particular underwriter may leave, lose their jobs, or the underwriter just folds. They are forming new syndicates. You know, I wouldn't say that it's a dollar for dollar replacement, but there's enough dynamic in the market where some of the better individual underwriters are finding new homes or forming new Lloyd's markets, which are being approved by Lloyd's now. And one of my longest standing, friendliest supporters was at an underwriter house. He lost his position. He went to a new group, and Lloyd's blessed them. And commencing Jan 1, there's going to be new capacity in the market. That's a fantastic dynamic. But in order to be able to take advantage of that, you have to know these individuals. You have to know where they're going. You have to know what the capacity is for these new houses. So the crisis is creating opportunity for insurers as well. So while some get out, others are picking up the slack. I would say in some, there's still a net loss for the moment, because we're not done with this cleansing, if you will. I think, again, 2019 is going to be a pivotal year, but I think going forward, you know, those that have the ability and the knowledge and the support and the capacity and the capital will find that there's always going to be a need for political risk, trade credit insurance, because trade is integral to what we all do. And to do the trade, you need the financing, and to do the financing, you need the risk mitigation tool.